Good morning, everybody. Thanks for joining us. For those who are popping in right away, we're going to start shortly. Give us about a minute and we'll get started as people trickle into the room here. Good morning. Thanks for joining us. We're going to get started in just a minute and wait for everybody to join us today. Good morning, everyone. We'll get started shortly. Just going to wait for everybody to come into the room here. Good morning, everyone. Awesome. We'll give it about 30 more seconds and then get started. Awesome. All right. Well, good morning. We'll get started today. Thank you for zooming in with us. On behalf of the Sandbox Centre team, welcome to our Experts in Residence session, Financial Growth. For those who haven't been acquainted with me or the Sandbox, I'm Mackenzie. I'm one of the 6 members of the team. We're located downtown Barrie and online to connect people and their ideas to business resources on their journey to success. As a result of the COVID-19 pandemic, there are a number of accounting considerations for business owners, lenders, and other stakeholders. These considerations will have an impact on almost every entity. And today, we're super excited to have financial experts Wayde Putnam and Austin Robello of Grant Thornton discuss topics surrounding how to understand financial reporting implications for your business as it relates to COVID-19. We know some attendees today have pre-submitted their questions, but for those of you who have some questions throughout the session, don't be shy. Please use the Q&A feature that's just at the bottom of your screen. And we'll be monitoring this throughout. We'll try to get to answering as many of your questions as possible towards the end of the session. And just before we get started, wanted to thank all of our community partners for supporting with the sharing of our events. And of course, a big thank you to Grant Thornton for sponsoring today's session. So without further ado, I'd like to welcome Wayde and Austin. Over to you guys.
Thanks, Mackenzie. We're thrilled to be here. Can I just double check that you can hear me or? Okay, yep. Seeing a nod there. So welcome everyone. My name's Wayde Putnam. I'm a partner here at Grant Thornton in our Barrie office and also have some responsibilities in the province as a whole. As Mackenzie indicated, you know, we're thrilled to be with you today and share what we've outlined as some financial reporting considerations for private enterprises related to ASPE. And I would suggest just to expectation set, this is an awareness session. We're absolutely happy to, as we go, please ask questions or also respond to Q&A at the end. Or following the session, please feel free to reach out to Austin and I. Our intent here is really to reach out to this group as a partner with the Sandbox Centre to local businesses so that you as owners, finance people, other stakeholders in the organization, and I actually see some bankers on the line here as well, which is great, and a lot of friendly names and faces. So thank you for reaching out. Want to engage in an open conversation of the things that we're thinking about, you know, as folks that focus on financial reporting and stakeholder needs, so that you can think about these concepts as they relate to your business or potentially your clients in advance of year end. Not everybody's a calendar year end, and Austin and I and our teams have been working through some early reporting with, let's say, some of our March, but more so June 30th year end reporters. We're coming up on the September year ends, but as you look towards December and, you know, the volume of companies that are there, these are the things you want to get in front of, think about, and if need be, talk to your bank, your stakeholders, and others, because this is an evolving situation. So with that, hand it over to Austin. He'll introduce himself as well.
Hey there, everyone. As Wayde mentioned, my name is Austin Robello. I'm a manager in the assurance practice, and I work primarily out of our Mississauga office, but I do spend some time in our downtown Toronto office as well. I primarily perform audits and other assurance engagements, but I do work in our accounting advisory team quite often as well. So my role is kind of dual faceted in that sense. And the bulk of my client base operates in the manufacturing, distribution, and commercial product space. So with that being said, I will kick off the presentation. Before we get started, I just kind of want to go through a disclaimer just to cover ourselves legally. So the information contained herein is general in nature, as Wayde mentioned. It is not and should not be construed as accounting, legal, or tax advice or an opinion provided by Grant Thornton LLP. This material may be applicable to or suitable for specific circumstances or needs and may require consideration of other factors not described herein. You should consult your Grant Thornton advisor to obtain additional details where needed. So now that that's covered off, I'll go through our agenda for today. And then I'd just like to open the floor to questions at any time, as Mackenzie said. Again, we want this to kind of be an open dialogue, so use the Q&A function as needed. So this webinar will be split into three main focus areas. The first is common accounting issues and their associated financial impacts from COVID-19 related events. So obviously there's a number of events that could take place, but we've done our best to summarize what we feel is most prevalent in industry today. So these are subsequent event considerations, going concern considerations, impairment of assets, and government assistance programs such as CEWS. Next, we'll briefly outline recent and emerging issues that have came to light due to COVID-19 related events. And again, we've highlighted the ones that we believe to be most prevalent in the industry today. So these are rent concessions, salary continuance, defined benefit obligations, current and long-term debt classification, and non-refundable fee arrangements. Finally, we'll then wrap up with a question and answer period, and then wrap it all up. So now that all the administrative stuff's out of the way, I'll dive into the common accounting issues and financial reporting implications arising. So before we discuss the first topic, which is subsequent events, we do want to clarify a very important point. There's a lot of confusion about how the COVID-19 pandemic will impact an entity's financial statements. So before assessing how an entity's financial statements will be impacted by the COVID pandemic, it is important to recognize that the existence of the COVID-19 pandemic itself is not an accounting event. Rather, it is the impacts caused by COVID-19, which could result in financial reporting implications. So as an example to kind of explain this, because I realize that could be a little bit confusing, an entity might be eligible to receive government assistance programs such as CEWS that were introduced and would need to determine how to account for that government assistance. Another example, an entity might experience a significant decrease in sales and or profits and may need to and as a result may need to test their assets for impairment. Although the COVID-19 pandemic is a driving factor behind both of these events, it is a distinct events themselves that will result in the associated financial reporting and not COVID-19 itself. Therefore, we believe, and a lot of the industry believes, that almost all entities are likely to experience several COVID-19 related events and not one in COVID-19 itself. In order to determine how and when to recognize the financial reporting implications from COVID-19, we must first assess each event individually and determine whether it occurred during the reporting period or in the subsequent events reporting period. I'll go through what the subsequent events reporting period is in a little bit, just to kind of give a refresher. But in order to help with this assessment, we must first understand the timeline and the kind of chain reaction of events that occurred with COVID-19. And I know it's now September and it seems like forever ago, but I'll just kind of touch up on it again. So on December 31st, 2019, the first cases of COVID-19 were reported to the World Health Organization in Wuhan, China. On January 25th, 2020, the first case of COVID was identified in Canada. On January 31st, 2020, the World Health Organization declared the outbreak to be a public health emergency of international concern. And on March 11th, 2020, the World Health Organization formally declared the COVID-19 to be a global pandemic. And from March 12th to March 22nd, 2020, every province and territory in Canada declared a state of emergency and tightened their restrictions. So now that we've kind of refreshed the timeline, we'll now go into the specific events. The diagram on this slide depicts how Canadian entities will reflect the impacts of COVID-19 in their financial statements during their reporting period end. Most entities with a reporting period ending on or before February 29th, 2020 will consider all COVID-19 related events to be non-adjusting subsequent events. Again, I'll go into what non-adjusting versus adjusting subsequent events are in a little bit. The exception to this general rule is for entities that have operations in Wuhan, China, given that it was detected earlier in Wuhan versus Canada and other international countries. The first cases of COVID were identified in Canada on January 25th, 2020, as I just mentioned. Therefore, for most Canadian entities with reporting periods ending on or before February 29th, 2020, the only mention of COVID-19 would be in a subsequent event note. Furthermore, if the entity's financial statements were completed on or before February 29th, 2020, it is possible that the financial statements will not include any disclosure about COVID-19. Subsequent to February, beginning in March of 2020, it became clear that the COVID-19 was going to have drastic impacts on the global economy. It was during March that most provinces in Canada closed their economies and financial restrictions began to be realized. Therefore, entities with a reporting period ended on or after March 31st, 2020 will likely have COVID-related events that fall within one or more of the following three categories. The first would be those that occur during the entity's reporting period. So those would be your standard transactions that occur within the calendar year. Those which are considered adjusting subsequent events. Again, I'll go into this in a little bit. And those which are considered to be non-adjusting subsequent events. So we've kind of broken those activities down into three categories. So COVID-19 events so this will be the first category that I'm just going to touch on briefly. COVID-19 related events that occurred during the entity's financial reporting period are accounted for just as any other transaction would be accounted for throughout the year. For example, if an entity if you announce a plan to discontinue or suspend certain operations of your company due to the COVID-19 fallout, you would apply the relevant guidance in ASPE in this case for discontinued operations, and then you would account for and or disclose the necessary information based on that guidance, just as you would do if it was just a regular year and you decided to discontinue operations. In the next slide, we'll take a closer look at the other two types of events. So subsequent events, as I just mentioned, are events that occur during an entity's subsequent events period. Now, you're probably wondering what a subsequent events period is. So the subsequent events period is the period from the entity's fiscal year end up until the date in which the financial statements are completed and finalized. Under all Canadian financial reporting frameworks, entities are required to distinguish between subsequent events that are adjusting. So adjusting subsequent events are those that provide further evidence of conditions that existed at the balance sheet date, and non-adjusting. So these would be events that are indicative of conditions that arose after the balance sheet date that you are not aware of during your fiscal period. It is important to distinguish between these two types of subsequent events because the financial reporting impacts differ between the two. So for each material non-adjusting financial event, for each material non-adjusting subsequent event identified, an entity must disclose firstly, a description and the nature of the event, and B, if you're able to, an estimate of the financial impact of the event. Alternatively, an entity will account for an adjusting subsequent event exactly the same as you would have if the event occurred during your financial reporting period. Therefore, you would disclose the information about the event in the general notes to the financial statements rather than in a subsequent event note. Now, you're probably wondering what a few of these examples would be. So we've kind of put together a couple examples. Again, this list is not exhaustive, but rather some that we've seen in the industry. So the first would be supply chain disruption, the assessment of certain purchase or sale agreements as onerous contracts, declines in the fair values of investments held after the reporting period. So for example, pension plans or any other investments in that nature, announcing a plan to discontinue or suspend an operation, announcing or commencing the implementation of a major restructuring or downsizing, abnormal large changes in asset prices or foreign exchange rates, entering into significant commitments or contingencies, such as issuing significant guarantees to related party, rent concessions, which I'll go into a little bit later, and other possible lease modifications, and qualifying for funding under certain government aid programs, which Wayde will go to in a little bit. The important message to take away from this slide is that the type of event does not determine whether it is adjusting versus non-adjusting. Rather, it is the timing of the event. To demonstrate how the concepts would be applied in practice, let's look through the example on the slide now. In this example, we will look at private enterprise A, which has a March 31st reporting period end. In March of 2020, Enterprise A began to see significant revenue decreases due to the closure of its manufacturing facility effective March 13th, 2020. March 31st was this Maple Leaf company's year end. On April 15th, 2020, during the subsequent events period, it was notified as a result of the difficult economic environment that one of its major customers declared bankruptcy. The customer owed the enterprise a significant amount of money at that date. In April, May, and June, revenues continued to decrease further and certain employees were terminated. The enterprise then applied for the Canada Emergency Wage Subsidy CEWS, which again, Wayde will go into a little bit later. Private Enterprise A later released its financial statements on July 6, 2020. In this scenario, the entity is what we would call a mixed model scenario. It does have COVID-19 related events that occurred during the financial reporting period, but it also has some that occurred afterwards. So it has both adjusting and non-adjusting subsequent events. As a result of all these events, for the purposes of its March 31st financial statements, Private Enterprise A would do the following. First, they would conclude that there are indicators of impairment on their assets. I'll go through what indicators of impairment are in a little bit. So they would measure and record any impairment losses for the year ended March 31st, 2020, considering all available cash flow information up to July 2nd, 2020. And they would disclose the impairment in the related notes. This is because conditions of impairment were present prior to the subsequent event period. They would then account for and disclose the bad debt expense related to the bankruptcy of its customer. Again, this would have to take place because there were conditions and suggestions that their customer was in financial difficulty prior to the subsequent event period. They would then conclude that there are indicators that their ability to continue as a going concern may be impacted. They will then have to perform an assessment and substantiate whether or not they are able to operate as a going concern going forward. They would consider whether in the general notes to the financial statements to disclose the overall impact of COVID-19 on the business to date and management's outlook regarding potential impacts going forward. And they would disclose that Entity A expects to receive funding under the CEWS program offered by the government, but did not recognize the benefit of the CEWS on its operations during the fiscal period. So moving on, some entities with reporting periods ending on or after March 31st have questioned whether it is still necessary to include a subsequent event note that describes COVID-19 due to the fact that pretty much everyone in the world knows what COVID-19 is and does know that it is having drastic impacts on the economy. As mentioned, a lot of these entities will fall into the mixed model scenario, and they will likely have to disclose information about COVID-19 related events in the general notes to the financial statements based on the requirements of the specific standards that it applied to account for the event. So for example, employee termination benefits, these would be disclosed in the employee benefits note and not the subsequent events note. As well, you would disclose information about the significant non-adjusting subsequent events in a subsequent event note since COVID-19 pandemic is still occurring. Eventually, and who knows how long this will take, but eventually entities may no longer require subsequent events disclosure with respect to COVID-19 in their financial statements. However, even in this circumstance, the financial statements may still contain disclosures regarding the impact of COVID-19 related events that occurred during the entity's financial reporting period and/or those that are considered adjusting subsequent events. Ultimately, we believe that it is highly unlikely that the majority of Canadian entities will have some COVID-19 related disclosures, we believe that it's highly likely, not highly unlikely, that we feel pretty much every entity should and will have COVID-19 related subsequent event notes. Finally, I'm sure you're all aware of this, but just to kind of touch up, because I have seen this in a lot of companies as well. It is important with note disclosures, specifically subsequent event note disclosures, that you tailor the note disclosure to your specific operations and not just give a generic templated response. We want to give the users of the financial statements as much information as possible about the entity. So again, it's very important to tailor the impacts to your operation into that note. So now that subsequent events have been discussed, I'll pass it off to Wayde to discuss our next topic, which is going concern.
Perfect. Thanks, Austin. Any questions, please feel free to jump in. I know that was a lot to take in, but I think, Austin, you did a really good job in framing the reason and the concept of why the notion of subsequent events will come up. Going concern is an interrelated item, and also a necessary element to consider in terms of, you know, the key things, and primarily, you know, related to COVID. Just to focus on accounting standards for private enterprises, it contains guidance related to going concern that outline that financial statements are effectively prepared on the assumption that an entity will continue to operate or exist as a going concern. Further, from an accounting standards for private enterprise perspective, it explicitly states that each reporting date, management is required to assess that the entity's ability to continue as a going concern is appropriate, and management needs to consider all available information about the future, which at least, but is not limited to, the next 12-month period. So all that said is management has to make an assessment about the business's ability to continue for at least the next 12 months. And I would outline the 12-month is not necessarily a bright line. Historically, a number of years back, it may have been, but things have evolved where it's at least 12 months, but generally 18, 24 months. It's for the foreseeable future at the point that you're reporting. The factors that are generally considered can be a wide range of factors, but the most common are really current and expected profitability, any debt repayment schedules, and the potential sources of replacement financing, if applicable, and really the ability to continue providing services or selling goods, which certainly COVID has had implications on many of those for many organizations. So in the event that management, along with your auditors, take a look at the current situation of the business, and there's material uncertainty about the entity's ability to continue as a going concern, the next step would be to include a going concern disclosure in the notes to the financial statements, and there'll be a cross-reference in the event that you have assurance in your review engagement or your auditor's report. Because the assessment really covers a period of not less than 12 months, all events that occur during the entity's subsequent event period, which Austin outlined, are considered when evaluating whether there's any significant doubt about the ability to continue. So in other words, if during the subsequent event period, even if items aren't considered adjusting subsequent events, they must still be incorporated into the going concern assessment. So that's a distinguishment to make. And events or conditions that cast significant doubt on the ability of the entity to continue should be disclosed if there are material uncertainties. So all that said is, in the subsequent event period, so after year end, so in the scenario of a December 31st year end, up until the point of management, but also the external accountants issuing the report, the subsequent events period is to be taken fully into account in terms of management's assessment of going concern, and if any items need to be included in the financial statements as a result. I'm going to hand it back to Austin to talk about another correlated item, but a separate item, the impairment of assets.
Thanks, Wade. Yeah, so impairment, going concern, and subsequent events are all kind of intertwined, kind of in a negative connotation with COVID-19. So I'll go through this now. So as I'm sure you're all aware, ASPE requires that all assets must be tested for impairment when indicators of impairment are present. The fact that there has been significant adverse change in the business climate in which mainly all Canadian entities operate in is a potential indicator for impairment. In other words, the recent economic conditions caused by the spread of the pandemic will be considered an indicator of impairment for many entities in Canada. This means that most entities will need to test one or more of their assets for recoverability and/or impairment. Now, we pretty much, across the board, we pretty much expect there to be a lot of impact with impairment this year. So we just kind of wanted to outline a few examples. A lot of people, when they see impairment, they think of intangible assets or goodwill, but impairment is present across the balance sheet. So we've highlighted a few examples here. So financial assets such as accounts receivable or portfolio investments. A trigger for impairment with this, which I outlined in the subsequent event example, would be anticipated financial difficulties of the other entity. So if one of your very large customers, you know that they're having financial difficulties and you don't expect your AR to be collectible, that is an indicator of impairment, and it must be considered when you're recording the transaction. So inventory, this one kind of goes without saying. If your goods are damaged or spoiled, that is an indicator of impairment. Investments in other portfolio investments. So if you have an investment in a subsidiary on your balance sheet, a trigger for impairment with respect to this would be significant financial difficulty and significant adverse change in economic environment in which the entity operates. Tangible capital assets and intangible assets. An example of indicator of impairment for these would be a significant change in the manner or extent the asset is used or expected to be used. So for example, if you have a number of machines that used to produce a certain product that is no longer in as much need due to the COVID-19 pandemic, that would be an indicator of impairment because the cash flows associated with those assets are not what they were expected to be before. So then you will need to prepare a cash flow analysis, which I'll go into in a little bit. And then finally, goodwill, which is the one most people consider when they think of impairment. Significant adverse change in the legal factors or business climate in which the entity operates. So now that I've gone through the indicators of impairment, we'll kind of touch on the how to go through the related cash flow analysis on the next slide. So with respect to impairment testing for assets, you only consider conditions that existed at the balance sheet date. And I know Wade touched on this a few moments ago, but I just kind of want to drive the point home because there is a key distinction here. So for impairment testing, you only consider conditions that existed at the balance sheet date. That's because at the balance sheet date, you're valuing your assets, liabilities, everything else at that date. So you only consider conditions at that date. And you only incorporate information in the subsequent events period that provides additional information about those conditions that existed at the balance sheet date. On the contrary, as a going concern assessment, you consider all factors leading up to the date that the financial statements are completed in your assessment, sorry. So for example, if after the fact you have a huge adverse change in your operations, you would consider that in your going concern assessment versus you would not consider that in your impairment assessment. So that is a key distinction to make there. And again, the cash flow projections is a big onerous task, especially when you're considering things like intangible assets and goodwill. The cash flow modeling for that can be rather complex. So if you do run into issues with that, definitely reach out to an advisor because those can be tedious and very complex calculations to make. Now that I've gone through a brief touch up on impairment, I'll now pass it over to Wade to discuss the Canada Emergency Wage Subsidy queues.
Sure, and before I begin, maybe I'll just pause. Are there any questions that anyone wants to ask at this stage?
Wade, there are a couple questions that came in if you'd like to answer them now.
Sure, I can say before jumping. I can say before jumping in, we're about to get to some of the more, I wouldn't call it good news, but the more positive news. We've been through a lot of challenging implications here, so I realize some of this is in a light of difficulty. So, in any event, sure, happy to deal with the questions now.
Some of the questions that have been have asked have to do with SEBA and government assistance. So I mean, we could wait and.
Absolutely. Sorry, no, I meant with respect to the subsequent events or going concern.
Yeah, no, for sure.
Impairment.
Yeah, I don't see any that relate to that.
That's perfect. And I hope everybody's still awake. I know this excites some, but not others. So then with that, we'll maybe just jump right into the government assistance. So in response to the economic impact of COVID, the federal and provincial governments created various programs which have, received widespread media, and most of you are probably aware of. But we're going to focus on a couple of the key programs that likely impact most businesses. Certainly happy to discuss some of the other programs at length offline as well. But the ones we'll focus on today are the temporary wage subsidy, the Canadian Emergency Wage Subsidy, the Canada Emergency Benefit Account, or CEBA, as Mackenzie referred to it, and many do, and the Canadian Emergency Commercial Rent Assistance Program. So just want to highlight, if your entity is receiving assistance from the government under one or more of these programs, that management needs to determine how to account for these from a presentation and a disclosure aspect. And this means that the entity will need to include a new accounting policy note, as well as the accounting and disclosure. In our discussion, we'll focus on the government programs of the CEWS and the temporary wage subsidy, and just provide a quick overview of each program and explain how they should be recorded. So with respect to the temporary wage subsidy program, in March 18th, the government announced the TWS program, which effectively provides that eligible employers, which includes most small businesses, would receive a 10% wage subsidy. And the subsidy really equals 10% of the remuneration paid during the period from March 18th to June 19th, with a maximum of $1,375 per employee, up to a maximum of $25,000 per employer. The next program and the most substantial program is the Canadian Emergency Wage Subsidy. And under the first phase of the program, qualifying businesses were provided up to 75% of employee wages, with employers being encouraged to contribute the other 25%. And the maximum subsidy under the program is $846 per employee per pay period. The initial qualification for CEWS, notwithstanding a bit of transitional timing in March, is a reduction of 30% of revenues to be able to qualify for this quite substantial program. I'll talk about it in a few minutes. There's been some changes to the program where effectively the 30% qualification criteria has been removed, and I'll go through some of the timeline of that. But this program has recently opened up more substantially to all businesses if there's a reduction in income. But it's also on a scaled basis where if the reduction in income is lower than 30%, the benefit is also scaled back. So it's a bit of a sliding scale intended to allow more businesses to qualify, but on a proportional basis. It's actually pretty complex now since some of these changes have been made. So now let's look at some of the programs as we go into the next slide and a timeline of events. So the temporary wage subsidy was announced in March, as I'd indicated, and with respect to financial reporting, if the entity had enough of its information available as of March 31st to determine whether it's entitled or not, they can assess whether it's reasonably assured whether they'll comply with the conditions of the subsidy, which you then may or may not account for. In terms of the Canadian Emergency Wage Subsidy, as we mentioned before, the program was announced in March. And further details were mentioned even in June. And subsequent, there's been some other changes. Given the status of the programs, and in particular the fact that the details were not announced by the government until at least April 1st, as they were enacted into law, most companies aren't required to establish reasonable assurance to comply with the conditions for the period of March or before. And frankly, I think for most of you on the call, accounting for these likely takes place subsequent to April. So with respect to that, just want to outline that most of the recognition criteria should be on a as you receive basis. So if you're receiving government assistance, you should be recording it on a as you receive it basis. If you do have a scenario where you're perhaps a March 31st year end and you haven't finalized yet, be happy to talk through that assessment criteria of whether you had sufficient information by March 31st that you recorded or not, and it can get a little convoluted, but we'll park that for now. In terms of the CEWS program, on July 17th, the minister announced some additional changes that would broaden the reach of the program and target further support, frankly, for all entities. Some of the key changes, which I was alluding to earlier, extend the CEWS program until November 21st, 2020, which is the end of the financial period beginning effectively December 19th, 2020. And the intent's to provide a varied subsidy rate depending on how much the entity's revenue decreased. So that's the sliding scale that I was alluding to. And it effectively allows entities with decreasing revenues of less than 30% to qualify. The proposed changes are effective for claim periods starting from July 5th, 2020 onwards. So entities have a choice between the old calculation, old being the March and April and 30% reduction, or the revised July changes, which is referred to as the new calculation. So you have a choice between the old or the new calculation for July and August. Subsequent to August, all entities must use the new calculation. So as I indicated before, the rules are becoming more complex. There's some choice in terms of the July and August periods. And you know, in some cases, there's a sensitivity analysis to determine what might be best for your particular circumstances. In terms of measurement and presentation and disclosure, under ASPE, the funding for the government programs are considered government assistance, as it provides assistance to the entity to influence business decisions. And therefore, the funding will be accounted for in accordance with the government assistance standard, section 3800. Government assistance received toward current expenses must be included in the determination of net income for the period. However, entities applying ASPE have some element to choose in terms of presenting the amounts as separate lines in revenue or other revenue. There's also some choice in terms of presenting it as a separate line in expenses or a net of other expenses. The key here is it can be included as another revenue or a reduction in expense, provided the accompanying note disclosure clearly indicates the amount of government assistance received and where it's been recorded. In terms of the CEBA program, so this is the Canadian Emergency Business Account Program. This is an interesting one, and I hope many of you have taken advantage of it, which is which provides for an interest-free loan of $40,000 to small businesses and not-for-profit organization to cover the operating costs during the period where revenues have been temporarily or otherwise reduced. And the loans have been received through entities in coordination with their financial institutions. The key elements of the CEBA program are it's 0% interest until December 31st, 2022. So really it's a 2+ year loan intended to be a fast injection of capital into small businesses. The principal amounts are up to $40,000 and no principal repayment is due until December 31st, 2020. Certainly voluntary payments are allowed to be made earlier than that. The one interesting aspect, other than providing short-term working capital and funds to assist businesses in this really challenging period, is there's a forgivable component of up to 25%. So in the instance of a $40,000 loan, forgivable of up to $10,000 if the amount's repaid December 31st, 2022. Any remaining balance after 2022 will be converted to a non-revolving 3-year 5% loan. So effectively, this is a really interesting program where $40,000 is available, provided it's repaid, $10,000 is forgiven. So under the forgivable government loans account, with respect to the government assistance section 3800, the guidance for accounting on forgivable loans is that the forgivable portion agreed upon at the commencement of the arrangement, so upfront, is in substance no different than a grant, and as such, it's applied effectively in the same way contingently as a repayable government grant. So since the forgivable portion is intended to aid with current expenses, the forgivable portion is generally recognized in income when the entity is entitled to receive it. So more or less for anyone that's obtained the CEBA in the current year and has the viewpoint and the ability to continue as a going concern and expects to repay the loan come 2022 in its fullness, then the $10,000 amount would be taken into income this year. Similar to some of the other programs from a disclosure aspect, we'll present the forgivable amount as a separate line in revenue, or there's some choice to show it as a separate line of reducing the expenditure in the current year. And again, really just the key element is to make sure there's clear disclosure in the note to the financial statements. The remaining amount, so in the $40,000 example, the remaining $30,000 is a non-forgivable loan, which would be accounted for under financial instruments, section 3856, which effectively requires to be measured at fair value. So in most cases for private enterprises, fair value would likely in all practical basis be the $30,000. in terms of next steps here, I'm going to hand it over to Austin. Actually, you know what? I'm going to loop back. I think, Mackenzie, you indicated there were a couple of questions on.
Yeah, for sure. We can get to these quickly here if you'd like. One person is asking, will the SEBA loan be presented as long-term debt until the last year of interest only, or will it always be considered current?
I think the view would be it'd be long-term as it's due in 2 years with sufficient note disclosure, and considering the intent to repay. So if the intent to repay and the ability to repay is there, you would take the $10,000 into income this year, and the $30,000 would be a long-term debt.
Yeah.
Perfect. And next question, will SEBA proceeds only be taxable in 2020, or will there be future considerations as well?
So the proceeds shouldn't be taxable for SEBA, and I'm assuming we're relating to the loan element, other than the $10,000 income.
Yeah.
So it really, again, on an individual basis, management will make a determination in terms of their ability to repay and their plan to repay. So provided that's management's intent, the $10,000 would be included as part of determining income with respect to this year. And that would be the only amount potentially subject to tax.
Perfect. And one last question before we move on. How do we report wage subsidy on T4s in year-end accounting to CRA? Somebody is asking.
Good question. So the wage subsidy will be reported at the entity level, and it's received by the entity. So that I think it's in. I have to double check. It's a good question, but I think the intent is that the T4 process would be wages and eligible wages paid normally because they flow through the entity, and the treatment for the wage subsidy is specific to the corporation. So there shouldn't be any change to the individual, the funds they've received as a result of employment. So T4 process should remain the same, and the accounting for the subsidy should be within the corporation. But I can take that away, but I'm quite certain that's the intent of the program.
Perfect, thank you.
Good questions.
Yeah, very good.
As I said during the Qs or the wage subsidy program, the 75% program, again, some of these changes that were made in July to remove the requirement for the 30% reduction in revenue have allowed a number of businesses that perhaps weren't meeting those thresholds and didn't previously apply to now qualify. You know, I can tell you, having worked with many clients and some of our specialty teams assisting those clients over the past number of months, the complexity has gone up. It's definitely worth a company's time and effort to work with their advisors to see whether you qualify or not. But since these final changes have been made and the threshold's been changed, there are a number of other complexities and idiosyncrasies to the calculations that just, it's more complex, but it's intended to provide assistance and generally is a beneficial outcome. So if you can look past some of the administrative hiccup of figuring out whether you qualify, most folks do. Any other questions right now? We're happy to loop back later too.
Nope, not right now. You can continue. I know we have about less than 10 minutes left here, so.
We're almost there. We just want to highlight a few other recent and emerging issues at a topical level. So I'll hand it over to Austin quickly then.
Thanks, Wade. So in the presence of time, I won't dive too deep into any of these scenarios, but I will highlight them for you, as Wade just said. So let's begin with rent concessions. For a lot of companies, especially small businesses, one of their most significant costs is rent or lease payments, not only for physical premises, but also for things such as machinery, vehicles, pretty much anything used to operate the business. So due to COVID-19, many rent concessions have occurred in many ways, shapes, or forms. These could be including waived or reduced rent for a period of time or changes to when amounts may be paid. Obviously, there's going to be associated financial reporting impacts with this. The main one being a modification to a lease. So if you do have capital leasing arrangements, a factor you might be familiar with is incremental borrowing rate, which is used to discount the lease payments to the balance sheet value. Obviously, this is meant to constitute a market interest rate that you would pay to obtain a similar asset on open market. So obviously, due to the fact that COVID-19 has heavily impacted interest rates, you may need to reconsider your incremental borrowing rate for capital leases. With respect to rent concessions on the whole, ASPE has not released a lot of guidance. IFRS and US GAAP have, but ASPE has kind of been late to the party for that. With that being said, they are expected to release an exposure draft in September of 2020. So within this month, hopefully within the next couple of weeks, so that you guys have time to account for the related rent concessions before year end. So we will keep an eye on that, and definitely keep an eye out for that as well. And if we do become aware of that, maybe we could pass that exposure draft out to you guys and kind of conclude on how to account for rent concessions. But at this time, it is kind of up in the air as they are going through that exposure draft. So next, I will briefly touch on salary continuance. So this is another accounting issue that is occurring somewhat frequently. So a salary continuance is when an entity decides to continue to pay the salary or wages of employees who were or will be sent home while the employee is not providing the service to their employer. In particular, this issue pertains to whether an entity must accrue for salary continuation costs at its period end. The long answer short is that there's not a widespread need for entities with a March 31st, 2020 year end or after to accrue for salary continuance. This is mainly because the only reason you would accrue it is if there's a legal obligation to. And then in a lot of these circumstances in the employee's contract, it is not structurally or legally written that this is owed to the employee. Rather, it is something that the company is doing to retain employees and keep them happy. So that is kind of where the line is drawn, whether you have an obligation to pay them or if it's kind of just something that the company is doing for good practice and to keep employees happy. Next, I'll talk about employee future benefit obligations. Obviously, with these, I'm sure if you do have pension obligations in your financial reporting, you are aware that there's a lot of estimates that go into this, and a lot of the estimates are based on economic factors such as interest rates, mortality rates, the average age, a whole number of factors that go into the actuarial assumptions. And I'm sure you're also aware that you are required to get an actuarial valuation every 3 years, I believe it is. And ASPE section 3462 mentions that you should get an actuarial valuation at least every 3 years, but it may occur more frequently due to changes in economic factors and other things. So given that ASPE requires an entity to obtain a new actuarial valuation in the year in which a significant event takes place, it appears that entities would be required to revisit the measurement of this obligation and get a corresponding actuarial valuation. However, ASPE also states that a significant change in the interest rate used in determining the discount rate to measure the defined obligation benefit at does not trigger a requirement for a new actuarial valuation. Therefore, we are of the opinion that you are not required to get the actuarial valuation simply because the interest rate is the main economic factor that will change. So rather, it is optional and not required under ASPE. Again, I kind of just touched on that briefly in the essence of time, but if any questions come to light through that, definitely let us know. So next, I'll pass it back to Wayde to talk through the remaining issues, and then we will wrap up.
Thanks, Austin, and just mindful of time as Mackenzie indicated, so I'll just be really quick here. In terms of debt classification, just want to highlight if you've had discussions with lenders, you know, for example, gone through waiver processes or refinancing or deferring payments, just highlighting the topical issue of consider whether debt is long-term or current. I know we had the question around the CEBA, but in terms of your overall debt facilities, if you've made adjustments or are having negotiations, be wise to consider what those current events and impacts might be on your classification. And then the other item to note is non-refundable fee arrangements. So there's a lot of discussion in supply chains and between customers and companies around credits or providing refunds and so forth, highlighting, you know, not to just assume that those items are automatically treated as revenue, depending on the nature of those items and negotiations. Just want to consider, I guess, the size and significance overall and cost benefit of digging into it, but not always just automatically referred to and put into revenue. So with that, I know we only have a few minutes here and want to respect everybody's time. I would be happy to take additional questions. And if we haven't been able to get to your question, or if you've got a more granular question, please reach out to Mackenzie and Chris and the team, or directly to Austin and I. Be happy to answer those questions.
Yeah, definitely.
Also, I think as Austin indicated at the beginning of the presentation, you know, we'd be happy to provide this information and the slide deck to individuals if you reach out as well. It's mindful of CASL and privacy and not bulk sending. So information's available and intended really to help you think through your stakeholder items. Are there any other questions that have surfaced?
There's actually just one more question left. You guys gave so much helpful insights here today, so I'm sure they'll be thinking of questions afterwards as well once it sinks in. But one question here, somebody's asking, can we prepare the financial report for the business by monthly, quarterly, or yearly reporting means? If so, which one is best?
So I think that's an interesting question. If I understand it correctly, would be in terms of how you're presenting it. I think that would generally be dictated by the user's needs.
Mm-hmm.
So if it's a bank, I think you would look to the banking agreement. Ordinarily, for private entities, it would be annual. But I think transparency with your stakeholder group is important. So supplemental outside of the year-end process, which would generally be an annual 12-month or a period report, supplemental information and transparency and sufficient information is I think always a good thing. Yeah, but in terms of what's generally recorded from the Canada Business Act, or if you're incorporated provincially, it would be annual. CRA requirements would be annual. And generally bank and other stakeholder requirements for private entities dictated by the jurisdiction of incorporation would be annual.
Yeah.
Perfect. Well, thank you. Thank you both so much.
I had just a couple other, you know, the questions that didn't surface here, but are coming up regularly. I'll just throw out quickly, really is around, you know, do all financial statements need the subsequent events note? I'll just share our view as a firm is yes. It's such a substantial event, as Austin outlined earlier, that effectively 100% of the entities we're dealing with are putting it in there due to the nature of uncertainty related to all of the items we discussed and other. And the other one is a lot of discussion around going concern and do I need to put going concern in my financial statements? Like many downturns in the economy over the years and other, just highlight, you know, sometimes going concern is a sensitive issue, but it's more the norm than the exception right now, just due to the uncertainty and the lack of, you know, precision, and that nobody knows what the future holds. There is a lot of going concern notes going into assurance financial statements, reviews, and audits right now. So I would encourage everybody, if there's a lot of uncertainty around your business and you're not in one of those sectors that is exploding for specific reason, to consider whether the going concern assumption might be applicable to you. And if it's going to go into your, say, review report or audit report, start having those conversations with your bank and your advisors now. But again, really just sharing our point of view around sensitivity to that is, given this, 100-year scenario of pandemic and the uncertainty related to it, it's certainly not unusual to have that note as well.
No, definitely not.
So I just wanted to share those two final points. I realize we're over time, and I'll hand it back to you, Mackenzie. I think
no worries. Thank you both for being here today. We appreciate Wayde and Austin from Grant Thornton for being here today. And thank you all for joining us and sticking with us. You guys gave some really helpful insights today, and we'll definitely provide your information to all the attendees here today if they want to reach out. Our experts in residence sessions vary from month to month across a variety of different topics. So you can definitely go check out our EIR program at sandboxcenter.com after, or follow us on social at Sandbox Centre for updates on all of our upcoming events as well. So thank you again so much for being here. Hope you have a wonderful rest of your week, and we'll see you next time. Thanks so much.
Thanks, everyone.
Thanks, guys.